So let's talk about the Federal Reserve and central bankers, as we know, have been reluctant to take action despite the risks of higher and longer lasting inflation. We know monetary policy support is ineffective in addressing, supply chain limitations, but I would argue that monetary policy drives demand, contributing to the buildup of price pressure. So in other words, the Fed policy can't produce more computer chips, but it can slow future demand for it. Understanding that it's part of the Fed's dual mandate for price stability, how has what we're hearing from the Fed officials changed since our last update?
Yeah. The old adage, haste makes waste, was certainly taken to heart by the Federal Reserve, in the last I'd say 15 years or so, to some extent, but definitely was the case over the first 9 months of last year. And undoubtedly, the Fed really was forced to change, and making a sharp pivot within the last 3 months. And part of that, potentially could have had to do with, Fed Chairman Jerome Powell being recommended by the Biden administration for another term, just taking away some of the uncertainty. But, as you mentioned, following the FOMC meeting in mid-December, Fed officials announced that they were not only going to double the pace of tapering. So again, this is not buying bonds at the rate that they were, expanding the balance sheet, the quantitative easing that we saw now several times since the global financial crisis, and significantly so, following 2020. But they also signaled 3 interest rate increases for 2022. And obviously that forecast reflects, their greater sense of urgency from the Federal Open Market Committee to try to quell inflation. And so, on current course, we'll likely see the Fed balance sheet reach a steady state level, meaning they're not going to be expanding it, nor will they allow bonds to be running off of it. And so they'll maintain the level from within the balance sheet for a period of time. And reaching that milestone, no longer having quantitative easing, no longer buying bonds in the open market as they have, is a prerequisite for these interest rate increases. And now the median expectation from the Fed is actually, as mentioned before, calling for 3 rate hikes in 2022, and then another 3 rate hikes in 2023. And that's obviously a much more aggressive line than we previously expected, but it's been very quickly priced into the market. And candidly has been something that we've been very well positioned for as a firm. Again, this, raising rates and inflation, I wouldn't say this is a playbook, because there's certainly a lot of economic outcomes that we may likely see this year. But one thing that we felt, very certain about coming out of, the amount of stimulus and the low interest rate environment that we've been in, especially as the economy was performing well, is that we had to position more defensively for rising rates across our portfolios. And so, to your earlier point, the Federal Reserve is not alone. Most global central banks are poised to nudge policy rates higher, but it is really taking the foot off the monetary accelerator, not slamming on the brakes. It really is a moderation. So again, it's not not seeing the slamming on the brakes taking place, at least not yet potentially. It really is just taking the foot off of the gas. Again, moderating. And so our investment committee does not see the Fed responding extremely aggressively to the persistent inflation, as they may have in prior cycles with a series of rapid fire rate hikes that would have likely already begun at this point. And one of the most important points is that the sum of the rate increases matters obviously a lot. And central bankers have learned of many lessons in acting too quickly within the last decade. And so we suspect the Fed will continue for the higher tolerance of elevated price pressures so that they do not derail an economic restart. But the way that central banks respond to inflation will be a very key story this year. And the risk of misreading the situation for 2022, in our opinion, is a significant one. And so we've continued to see treasuries, as I mentioned earlier, sell off in anticipation of a tighter Fed policy in 2022. Have continued to do so as we've started the new year. As I mentioned, the 10-year Treasury has moved closer to 1.9%, as again, the market is trying to be proactive in pricing in these policy decisions in the next 12 months and beyond. And so there are some Fed officials that have suggested that the Fed may be behind the curve on inflation, and they may need to raise short-term rates more in the near term. We've been hearing some rumors about maybe half a point or 50 basis point rate hike in March, which I think is unlikely, just given that the Fed has been very deliberate in the way that they're communicating likely policy decisions to market, so not to spook market participants. And so, at the end of the day, monetary policy and that, what what central bankers are doing all day is not a hard science. And we believe it's very much prudent to account for the elevated risk of policy error this year. And so, while our view is that the labor market and the Federal Reserve will ultimately determine whether inflation pressures are persistent or transitory or not, as opposed to these temporary supply and demand dynamics. And so I think at the end of the day, if you're asking me to make a bet as to how many rate hikes we see this year, I think market participants are maybe fairly too hawkish, especially given how we've seen economic data soften in the recent weeks and months. I think we'll likely see, again, 3 rate hikes, maybe 2 to 3, as opposed to 4 or more. But again, it very much is, as our colleague Mark Balser, who's our Director of Investment Strategy, gave the analogy the other day. It's sort of like Plinko. Once we start to see the momentum trending in one of the directions, the likelihood, that we'll see that quarter reach the other side of the board, I think, becomes much, much less. So,
yeah, Mr. Price is right. Let's move on to the labor market, right? And the recovery in the labor market has been one of the bright spots of the past 2 years. We discussed in a prior call that job openings have recovered to 2019 levels within a year and accelerated to all-time highs about a year ago. How do you think about the labor recovery and how it could impact the central bank policy?
Yeah, and we really have seen record job openings. We've seen record low levels of labor force participation. And labor force participation is the percentage of population working or actively looking for work, which has really led to solid wage gains and obviously improved household income as more Americans have gotten back to work. And so, unlike prior recessions where household income tends to fall and then slowly recover over years, we experienced a totally different situation, coming out of 2020 and the COVID-19 crisis because of that stimulus, where total household wage income has fully recovered, even with fewer Americans in the workforce, and households took home more, saved more, and spent more than they would have without COVID. And the unemployment rate just recently was announced, fell to 3.9% in December, which is down 2.8 percentage points since this time last year. And fortunately, we've seen 4.5 million Americans finding employment last year, which is absolutely phenomenal. Great news for the American economy, but it could lead to inflation sticking around a bit longer. And so as labor markets show these tight conditions, similar to what we saw in the economy facing before the pandemic, all-time highs, in workers saying that jobs are plentiful, rising job openings, involuntary quits, and low layoffs, again, there's a lot of negotiating power for employees, and as a result, wage pressure, which flows through into inflation data. And so when I said earlier, what causes persistent inflation, it really needs to be driven from wage growth, although it's not one for one. If we have 4% wage growth, we're not going to have 4% inflation. It generally, for every 1 percentage point, contributes about 0.5%, in inflation. And so it's about 50% flow through. But we've really seen, high record, job openings really all over the place, not just in hospitality, manufacturing, and leisure, where, the job market was hit the hardest, coming out of the lows of the recession that we saw 2 years ago. We've seen in transportation, retail, business services, education, and healthcare. And as a result, hourly earnings, employment costs, have risen 4 to 5%, which is close to the highest level that we've seen in 3 decades. And so, the Fed has definitely used this development and persistent, wage growth is really the catalyst for signaling for earlier liftoff to tighten monetary policy. And so, the good news is that both U.S. and global consumers alike are really in good shape. That should support the economic expansion this year. We expect GDP growth, globally to be closer to 5% than 6% as it was last year, and GDP to moderate a bit, here in 2022. Closer to 2% towards the end of the year, but likely closer to 3% for the aggregate, which is obviously down quite a bit from the last couple of years. And so, I guess the big takeaway is higher wages flow through in the prices. We expect goods-related supply chain issues to be resolved, as we mentioned earlier, but we also believe that labor force participation, will remain a risk, as the year continues, but should recover, especially as some of the financial cushions and COVID-19 risks subside. Again, the bad news is the labor market ultimately could pick up the baton, for the inflationary risks, from the temporary demand and supply imbalances. And so, again, I think in summary, the path forward will not be really the most smooth one potentially, going back to the Plinko analogy. But the problem for the Fed is that looking at their operating framework, it ties their credibility to healing the labor markets instead of fighting inflation. And the Fed has a dual mandate: full employment, which we're very close to reaching already, as well as price stability, which we're far from reaching. And it's been a very big problem for the Fed. And so this inflation-driven policy error could happen before they can react to it. And they're also facing political pressure from both sides of the aisle, especially in a midterm election year, and could certainly find plenty of supply side reasons to remain accommodative. And so again, I think one of the biggest risks this year is a Fed misstep and an overreaction to some of the inflation, amid a slowing economy. Again, not from free fall, but slower in absolute and relative terms.